Good evening. My name is Peter Resnicek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, June 21st, 2020. Happy Father's Day. I was kicking around all kinds of different titles for this video, pursuant to like what happened on Friday, and I was thinking like how to buy stocks at the right time, how not to get hurt in the market, how not to get smoked in the market, you know, all types of things like that. So I just settled on one of those because I thought to myself, I need to talk about this huge break on Friday, and I'm going to have to assume that all the people watching this channel, 25 to 30,000 views a week now, which is pretty amazing, and I do thank you for that from the bottom of my heart. I'm thinking to myself, if so many people are watching the channel and I see this break happening, it has to be a decent cross-section of those people had to be caught long in that, or either got long early Friday and then dumped their positions, as the news came out, whatever, and basically got hurt. And I thought to myself, I didn't get hurt at all Friday, but it wasn't luck. The reason I didn't get hurt Friday is because I was thinking that there was potential for long early, but I didn't get into any longs. And the reason I didn't get into any longs is not just luck or it just didn't feel right. It was very, very specific technical and market profile nuances. And I knew about those nuances even before the day started. As you know, I write Peter's Pre-Market Perspective every morning where I talk about all these market profile nuances. So I already had the idea of where the so-called go, no-go level was going to be for Friday. And when that didn't happen, it was time to just step back, all right? We're going to walk you through all of that, again, starting with the pre-market perspective and some of my thought process during the day. When I finish, we're going to go into the technical picture of the markets, discuss where Friday's sell-off left us. I kind of think there's still opportunity here for longs, but I obviously need some confirmation after Friday. We're going to talk about that. We're going to touch upon the inordinate relative strength on the NASDAQ 100, which continues to go. I mean, if you look at Fangman stocks, it's almost like as if nothing happened on Friday. Many of them so bullish. All right. All of that is going to tie in and lead us into the trade of the week, which is going to be a long that I had coming into Friday. I'm going to show you when I unwound it and why. And again, that's going to tie in obviously with the whole, don't hang around on Friday long and don't get into new longs, etc. All right. Last but not least, I'm going to touch upon gold. I did get into one thing on Friday and it was long gold. I did it myself. I did it with my subscribers, getting into a GLD call vertical going out about a month. And I want to talk about the specifics of that chart because it's been consolidating for so long. And I think next week could be the start of another leg higher in gold. All right, without further ado, let's get into it. All right, so let's begin with, let's start with ES here. We usually kick things off with S&P or we look at some of the majors. I purposely wanted to start with ES because the move down on Friday was a little bit more accentuated in the futures than it was in the cash market because there was actually a larger drop in the futures after 4 p.m. once the equities have closed. Futures trade a little bit longer than equities do, and there was a larger drop there. And you can see it's basically just a little bit more technical damage to the chart. And I use this term damage, really with quote marks and not, seriously. It's not like damage in capitals because thus far it's minor. But the point is that out of a bullish pattern, the market seemed to reverse out of nowhere. And obviously it was somewhat news driven, but it doesn't matter. As I go through this video and I lead you more through my mindset of what I was thinking in the pre-market and how I navigated the day, I hope it's helpful to you. So in order to do that, we're going to start from the beginning and go to the opening of the day. And this is where basically I give my thoughts every single day. Many of you who are watching this are already subscribed to this. And this is really kind of a symbiotic relationship for me, to be honest with you, is that I really enjoy writing this every morning and putting out all this information because it helps me to organize my day. One of the best things that was ever told to me about the market, it was told to me by Jim Dalton, who is my mentor in the market profile. I highly recommend people check out his work if you haven't yet. Is one of the things that he always said to me. He said, you want to try to organize information better than the next man. All right, and I've thought about that so much over the years, and it's really an amazing statement because the game is really won and lost by who can organize information the best. How much information can you take in and then parse it the right way to give the right amount of weight to different things in the market and then act appropriately on those nuances that have the heaviest weight and try and ignore those nuances that have far less weight. All right, that's really how the game is won and lost. So in the pre-market perspective on Friday, first thing I want to point you to is the chart of the profile, which I show here, and I'll show you on the actual profile chart. But my focus was really on the fact that we came into the market, and again, this is printed on Friday morning at 9 a.m. Eastern, so you don't see Friday's activity. We came into the market looking at what I call a 3-day balance. So you've got basically Tuesday here, you've got Wednesday, this is Tuesday, this is Wednesday, and this is Thursday, right? These are the 3 days coming in. And I call it a 3-day balance because basically value was unchanged. You have 3 value areas right near each other. We have almost equal highs here. Right, we had, or I should say we had a high here, an overnight high that barely got up over it. And more importantly, we have a gap here. All right, but mostly I was focusing on the fact that value didn't change. And I thought of it as a balance also because we know that if we look back in the market came from a much lower level coming up to here. So that's also a typical sign of balance where you have up and then sideways. And when you have up and then sideways, the natural inclination is to be thinking that the next move should be up. And I'll be honest with you, I'm thinking the same thing, but with a lot of caveats. And those are the caveats that I want to go over in this particular video to kind of show you that mindset, and hopefully maybe it'll be of help to you too. Okay? So first thing you'll notice is I talk about these key levels every morning. And importantly, what's the first thing that I talk about? It's actually a level that's not even anywhere near Thursday's RTH high, or regular trading hours high. It's actually the bottom of the gap. And herein lies the rub, so to speak. This is the most important thing to me about what happened on Thursday, is how the market acted going into this gap. You've heard me very often talk about a phenomena called WWSHD, or hashtag WWSHD, when what should happen does. And when what should happen doesn't, the market is speaking to you. The market is speaking to you very loudly and is telling you that the opposite has huge potential to occur. So as I was coming into the market on Thursday, my focus was, knowing that we were gapping up pretty big, I can't remember exactly where, but I know that on Friday morning we opened somewhere pretty high. The focus was going to be, were we going to fill the gap, right? And that's very, very important, right? This here that you're seeing here, this is actually the Thursday overnight activity. So we're going to assume that we opened, somewhere in here, right? And as we go on into the report, we'll just look at some of the stuff that I was thinking that I put on the page as I'm coming into it, all right? We had a strong true gap higher, meaning that we opened up out of range. Inventory was 100% net long. That's important. That means that that 100% of the activity was above Thursday's settlement, okay? And we were coming out of a 3-day balance. But importantly, this is very, very important again, we opened up inside of that balance. So think about that. This is right in and of itself, as the day is opening, you have a huge piece of MGI at your disposal. MGI, market generated information. I talk about this all the time. If you recall, we had a video a few weeks back, I believe, that was called MGI versus opinion or something like that. Remember, you want to make it your modus operandi to deal in MGI, deal in market generated information, not in opinion, not what the television is telling you, because that's absolutely worthless. Remember, they are purveyors of sentiment. They are not dealing in market-generated information, and that is very, very important. Market-generated information can only come from one place, and that's obviously the market. Okay, so the market-generated information this morning was the fact that we were opening on a huge gap higher, but even with that gap, we were not opening out of the 3-day range. We had a true gap opening outside of the prior day's range, but not outside of the bigger range. So when I see that, I'm immediately thinking, aha, overhead supply, overhead supply, overhead supply, right? All of it. Because if the market was opening here, up in this area, free and clear in the gap, I would have to be thinking there's going to be not only a lot of shock and awe from anybody who might have been short in the balance. Remember, the reason the balance areas break so hard to one side is because 50% of the people inside of the balance area are wrong. If that wasn't the case, how would there be a balance area? What creates balance areas? Balance areas are created by sellers and buyers being in balance. For every one seller, there's a buyer. They're coming into the market at about 50-50, and that's why the market goes nowhere, right? That should be obvious. And again, what am I doing? I'm thinking in advance of the psychology of the players. I'm trying to get into the head of everybody else. I want to come into the market every single morning wondering, what is their position? Where are they coming from? When the market opens here, are they going to be happy or disappointed? If I think they're going to be disappointed, what are they going to do? If I think they're going to be happy, what are they going to do? Do you understand? And I just follow. And that's really it. That's where all edge really comes from. There's a million different edges in the market, but to me, this is the strongest type of edge, is understanding the mindset and the inventory position of everybody else who is in the market, okay? So going on, the market opens, and we don't open inside of the gap up here. We open a bit lower, and we start to tank right away. So I say early on, you can see here at scenarios, this was actually my first scenario. I was saying, as discussed above, the odds are there for a fade. Fade just means you're moving opposite the gap. Thus, there could be opportunity early this morning. I always tell my people whether or not I think there's opportunity early or I think there's opportunity later. If you open up within balance, the opportunity is probably later. If you open up out of balance, there's potential for opportunity early. And this is super duper important because most newer traders do not understand when is the right time to step on the gas and when is the right time to take their foot off the gas. Because they're so hyped up about the process of trading and they think it's exciting or sexy or some other BS, they want to step on the accelerator every single morning as soon as that bell rings. And that is not correct. You have to understand there are going to be huge periods of time where there isn't money to be made, and you also have to know when to be aggressive and when not to be aggressive. But when you have a true gap outside of range, that is a time to potentially be aggressive. So I wrote, there is opportunity for a fade, and I give you some very, very specific strategies that you can work with. The usual strategies of shorting the first 1 minute low or shorting any cross back down through the open after a weak rally would apply. Put your stop over the high of the day in either case and target the overnight halfback first and then look for potential for the full fill to the RTH high. All right? Now understand that as I'm saying this, these are the nuances that really only matter to day traders. But I want you to understand that as I'm going through the pre-market perspective and the things that I talk about, they have enormous and inordinate value for longer term traders as well. And you'll see it when I get into the next section when I talk about what would potentially be the long case for Friday. And I wrote, the bull case for early trade could only be made if the opening drive or early trade can take out the 618 high. What's the 618 high? The 618 high is the high of the 3-day balance area. If so, look for clean signs of acceptance inside the gap, monitor closely for continuation, and target the top of the gap all the way up at 3168.75. So I hope that as I'm going through all this, there's a lot to unpack here, and there's a lot of different takeaways. But one of the things you should be thinking about right now is the fact that I literally just laid out 2 different scenarios of what could happen before the market opens. And understand that as just another trader like you, one of the millions that's interacting with all the other traders in the market, I don't know any better than you do what the market's going to do once that bell rings. I don't need to know that. Remember, the market's going to tell me that once it opens. But look at how much homework I just did before the market even opens to set it up so that I could lay out 2 potential scenarios of what to do at the open if I want to be aggressive. The odds probably favor a short, right? Because I'm gapping up, but I'm still opening in balance. So there's probably still some people inside of that balance area that are thinking, hey, I'm stuck long up here. I need my money back, right? They're going to be selling that open because they see it as a gift. Why? Because psychologically, it's getting them back to even. It's taking pain away from them. And that touches upon the psychology that I talked about before. Remember I was saying, who's disappointed? Who's happy? Is the current market activity or what is happening, is it causing people pain? Is it taking pain away from people? Right? Think about that for a second. Everybody interacting in the market is just a human being. What do human beings do? They go towards happiness, they go away from pain. They avoid stressful situations, right? They have defense mechanisms that kick in, that purposely save us from pain, right? We're evolved and smart enough to not walk out into the street in the middle of traffic because we know we're going to get run over. We don't put our hand in fire, et cetera, et cetera. Do you realize that traders act the same way in the markets? It's no different. So you want to come into the market every day with that framework in mind of where are the potential pitfalls, what could happen, what's not going to happen, and basically set yourself up. All right, so that's what I'm going for in the pre-market perspective, and I just wanted to kind of flesh that out, so to speak, a little bit, so you understand that I'm laying out potentially two very opposing scenarios here, right? I'm saying we could either fade hard off the open, that's probably playable because of the setup, or I'm saying if it's going to be a long, it has to do this, right? And that's where the key is, where I think all the money was made on Friday in not getting long and not getting aggressive, because the market needed to show and prove before, for me at least, before I was willing to commit anything to the long side, and that showing and proving would have meant going into that gap and filling that gap. And remember, it's all about when what should happen doesn't. 3-day balance, markets gapping up, pretty large gap up on Friday, right? At the high end of a 3-day balance. Should probably go higher. You got a gap above you that needs to be filled. The gap is a void of price action. Gaps, some people call them windows. Remember, the market doesn't like gaps. That's why gaps generally naturally get filled. When prices move into gaps, why do gaps fill? Because gaps are a void of price action and there aren't any sellers there. Nobody transacted business there in a long time, right? Or at least in the most recent sessions of the market, nobody was there. Okay, so that's really the psychology behind why gaps fill. So again, Friday, where was all the money made on Friday? The money was made, I believe, on Friday. Sure, there was money to be made on the short side. I mean, I shorted a few things here and there for day trades too, and that was great. But the point I'm trying to make is, I think the money to be made on Friday was in not getting long and in unwinding longs early, because of that gap fill failure. Seeing that there was potential for a fade in the market because of the setup, as I was saying, and the fact that, okay, we're already up at the top of the gap here, we gapped up nice and large. Why isn't the market moving into this gap? If the market can't move into the gap, I'm not interested in getting long, et cetera, et cetera. That's basically it. All right, let's do a short section on TA, where everything was left on Friday. Again, not really overly bearish. I think the case could still be made that the market's coming up, like this, a little bit of a pullback, and then what I sometimes call this a hook, because it looks like a fish hook. You got the hook higher. Totally potential for that. But I mean, if that's going to happen, no problem. We just need to connect our lines. We know that we had the trend line here. We sort of opened up above and failed right away. I think the easier play, honestly, is just going to be to wait for this red bar to get taken out. Just wait for the top of that bar of Friday S&P to get taken out. If the sellers were taken out or are taken out going, subsequently of Friday, no problem. Then we know that news or no news, Apple, COVID, whatever, it was a liquidation break. Liquidation break strengthened the market, and we could go higher. All right. Now, QQQ, as I was alluding to in the intro, painting a whole different picture. I mean, just so much more bullish, I think, still holding up into the middle of the channel, well off the lows here. And, as I look through some of the Fangman stocks, a lot of them, Facebook up 285, green candle. Amazon, phenomenal, up 21, kind of just holding there as a doji. What else we got? Netflix, really, really strong. We're going to get into Netflix in a second. It was the trade of the week, actually, so we're going to talk about Netflix in a bit. I think Netflix is going to push to the 470 area potentially next week, but look at such a strong close in Netflix. And just going on down the board, Microsoft almost hit the magic 200 number, but backed off just below it. I'm going to be looking for that 200 next week. Any weakness in Microsoft, I think, honestly, is a buy. I would welcome that. Anywhere like coming back down into range would be fantastic, especially to this prior high here at the 190, setting up that retest of the 200. But anyway, in the bigger picture, again, technically, has anything really been damaged by Friday majorly? Not really. And again, not really major damage. And two, if there is going to be longs, we know what the signal is. Very simply, just wait for Friday's high to get taken out, and that should be a setup that it's all clear. And it's time now for the trade of the week. Once again, coming to you from the Weekly Options Advisory. Very educational, I think. And again, I was trying to tie it all in with everything I just bent your ear about as we've come up to this point about why it was probably not a good idea to hold on to longs for too long on Friday and time to get out. This trade was very interesting, I thought, and again, very educational because it was a risk reversal that used a ratio spread on one side and a naked short put on the other side. Usually when I do risk reversals, like when we talked about that gold trade, you notice that it was Call vertical on one side, put vertical on the other side, rinse, repeat, and then call verticals above. This trade was kind of interesting in that the spreads were very complex. There was a lot of open-ended margin risk there, I will admit to that, but you can always cap that off with garbage puts and calls on either side. But I was long a ratio spread in Netflix on a very, very short time horizon too as well. That's also what makes this trade very, very interesting, is that I'm speaking to you on June 19th. This trade was only put on June 17th. And that's really the beauty of weekly options. There's so much opportunity every single week because you've got these expiries and all these really good momentum and moving stocks happening every single week. So there's always this rinse repeat where there's always something, to do basically. And if you can really get your TA down and have good short-term timing, there's a lot of opportunity in being what I call a net seller in some of these complex spreads. Remember, I'm never just selling premium just willy-nilly just to do that. I am not a premium seller. I am not an iron condor player. I am generally not a short vertical player either. I don't make my money selling credits. A lot of options advisories just do that, right? You sign up for it and all you get is short verticals, right? They just find areas where they think there's credit to be had. And that's fine, but that works well until it doesn't, right? You can make a lot of money with that over and over and over, and then you have 1 week where you get absolutely smoked and you're going to give back a month and a half worth of profits, because that's how the premium selling game works. But I do things a little bit differently around here. I do sell premium, but usually only as the other half of a risk reversal. I will sell premium because I want to take in credit and have money to spend on the other side to buy call verticals with it, or if I think it's down, reverse, just selling call verticals and buying put verticals, thereby creating not a riskless trade, but a costless trade. And this is important because I like to be in situations where if I'm wrong, I don't lose anything. And this kind of touches upon what I talked about earlier in the video. Remember how I was saying that the real money to be made, so to speak, on Friday was, to me, not really in like getting short at the top or whatever. It was just in the fact of not getting long and dumping your longs early. That's a position in the market. Not knowing and going to cash is a position in the market. Getting out of your trades and clearing the decks is a position in the market. And most importantly, avoiding situations that could cause loss, such as getting long on Friday before the market went into that gap, right? No acceptance into that gap above us. Lots of people didn't even know that gap was there. I'm sure they're watching this and like, whatever. I didn't, these are nuances that I wouldn't think to look at, and that's why I like talking about them. But understand, that's where all the money is made. A lot of people that are new to this game falsely assume that the money has got to be made in winning trades. Well, it is. But over time, and what really separates those that have staying power and those that flame out in a very short period of time is not how they win, it's how they not lose. It's about avoiding loss. You really, that's what I do in the markets all the time. I let the winners take care of themselves. The winners, it just happens. There's really not a lot to really even talk about. People who are new to the markets and are learning strategies and hopefully journaling. I talk about that all the time. Is in the early stages of this game, you should be journaling all the time. And I hope you notice that when you journal, you have to spend twice as much time on the losers as on the winners, because the winners aren't going to teach you anything. You're not going to learn anything from that. All you're going to do from that in the right-hand column where you put your notes is say, yeah, I bought it at X, I sold it at Y, it worked out, it seems like I did everything right. Okay, great. But again, there's not much to be learned from that. But what about the losers, where you made a mistake because of psychology, a mistake because you didn't see a nuance, and a mistake because you got long without the market filling the gap above us or going into the gap, finding acceptance, et cetera, et cetera. There's so many different pitfalls that you can fall into, how many things can get wrong, all right? So basically, just to recap, I just feel it's very important to remember that the consistency and the money is made in not losing. And your job really should be to work as hard as you can to get yourself out of situations where there could be loss. Don't hope, don't guess, etc. And then you'll see that basically the other side of the equation will more than likely just work itself out. All right, so the trade of the week is this Netflix trade. And again, as I just finished telling you, it was risk reversal with ratio spread and short puts. And you can see here the ratio spread was a 455, 470. That means that I was long the 455 calls and short the 470 calls. I had 2 units of those, and I was short 6 units of naked puts at 415. So let's go to a chart together and take a quick look at Netflix and just kind of walk through that real quickly to understand why I did such a thing. All right, so again, June 17th is when the trade came on. That was this candle here. Why did I like Netflix long on that candle? Well, again, it's never a guessing game. It's always, I don't want to use the word scientific, but there you go. Netflix broke trend, started moving to the upside. And why did I want to be long at 455 and short 2 times at 470? Well, look at the channel. Again, it's not ever a guessing game. It's always very specific. The high of the channel is at 470. So I'm thinking to myself, okay, Netflix has given me a signal that it's moving up. How is it giving me a signal? It is broken over the trend line. I don't know where it's going to go or what it's going to do over the course of the week. I'm not like super bullish on the market, but I definitely like this name. I saw that on that day it was showing a lot of relative strength. So I think to myself, what type of spread can I get into just for Friday that's not going to cost me too much? Well, that's usually a ratio spread. Usually you set up a structure like this, and you want the market to close somewhere in the middle, preferably right up here. And you can see the right up there, the 2 shorts are at 470. Makes perfect sense. And we paid a debit for that. Why did we have to pay a debit for it? Well, think about it. It was short term. By that time, I think there was only about $1 of credit left in the 470s, which is still pretty rich for a strike that I'm thinking that the market is never going to go to. And the 455s are obviously more expensive than that, right? So we paid a little bit of a debit, but we were able to get, I would say about, I think 90% of that debit or so back. You can do the math when you look back at the blotter by selling the 415s. And why did I sell the 415s? Well, look, here's your trend line. Here's the trend line. And so I sold these puts here naked, thinking that the market, if that was going to be in play, the market would have to go up, or Netflix go up, fail back through the trend line, go all the way to here to hurt those puts. And those puts were sold for 40 cents each. And again, why they are done in a ratio of 3 to 1, because I need to sell that many of them to cover the cost of the 455, 470s, basically setting it up so the net cost is close to 0. And then, like I was saying, that way, if Netflix goes sideways, then nothing happens. All right. So anyway, Thursday, market has an okay day here. And then Friday, we had an amazing close in Netflix, but notice that had I held on to the spread and not sold it, the 455 still would have went out worthless. Remember, they only have value if we go over 455, and thus, to me, the trade was a sell as the day unfolded. Now, again, was it any major, big, rah-rah winner? No. I only got 75 cents for one unit and $1.03 for the other unit. But the point I'm trying to make is why I was not holding on and hoping for higher because of what the market was telling me. This is 10 a.m. Netflix already starts cracking lower, and then it starts cracking lower. And as Netflix is trading like this, I'm thinking to myself, it is time to get out and take whatever profit there is in the trade and basically not be long. Now, obviously, in hindsight, Netflix held up a lot better than I expected, didn't really crack at all. That's a good sign. That's actually something that I'm going to be carrying forward in my narrative next week. When I think about where do I want to be long, I'm going to be thinking about the Fangman stocks, right? Or a stock like Netflix that held up really well. But I'm not holding on to those longs any longer than I need them, and I'm not playing the hope game, even though my cost is near zero, basically hoping that we're going to move up over 455. And this is a really, really important topic, I think. It's probably bigger than what I can spend time in this video. But again, if I can impart anything to newer options traders, it's this. Do not play options spreads in a binary manner unless you're trading something like a butterfly on the day of expiry and you're looking for a pin. That's a binary event. As a matter of fact, we were looking for a 1,000 pin on Tesla with my weekly options subscribers, and we actually nailed it. I put that out early in the morning, the $5 wide butterfly that was wrapped around the 1,000 strike on the put side was about 85 cents on Friday morning. And after you watch this video, you can go take a look and see where Tesla closed. All right? That type of trade is a binary event. The problem is that most people treat all types of options trades as a binary event, meaning that they're long a call vertical or something. Let's say it was Netflix, just for an example. They're long a 455, 460 or something. They're not getting out or paring it down at all as the week unfolds. They're holding it into expiry as if it's a binary event, meaning they look at it as like, well, I paid 80 cents for this, and if it goes all the way to 460 or over, the 80 cents is going to be worth $5. But that so rarely happens. It doesn't work that way. You have to be able to just look at everything very objectively and do what the market is telling you or take what the market is giving you. So in this case, even though I did have the 470s working for me that were sold for over $1 and went down to zero, I'm still long the 455s. And regardless of the fact that even though those 415s were going to zero and the trade didn't cost me anything, I'm still not interested in just letting that go to zero and say, oh, well, my initial debit was close to nothing, so whatever. You have to harvest profits as you see them in options, just like you would if you were long a huge raft of stock and you were selling it out incrementally as you go. Okay, last but not least, as I alluded to in the introduction, I wanted to end this video with some comments on gold. Gold has been in a very long consolidation period. Some people might consider this a long, dark winter, so to speak, because as I always say, gold is the heartbreaker trade. It just basically, you get in it and then it falls down and it just goes back and forth for long periods of time, not really going anywhere. And we're in one of those periods now, but I think there's potential here for that type of long, cold winter to turn into spring very soon. And spring it should, meaning spring out of this consolidation. Which has been happening here for quite some time. I'll just move this down a bit so we can see. If I draw that box again on the price action here in GLD, remember that usually a consolidation breakout should go at least the height of the breakout. So this one is about 157, I believe. Yeah, 157 to 165, which is 8 points, which means that if we did break out in gold, we should see 165 plus 8, which would put us up to here at about 173 in the GLD. All right, to that end, I have kicked off a longer risk reversal with weekly option subscribers. I haven't started selling against it, but that's this one. We are long 4 units here of the 164, 169, and I'll start selling against it as we go. Remember from the past video about the gold trade, it's all about whittling that debit down to zero, but seeing how well gold acted on Friday and the fact that, most importantly, what made me really get busy with it was the fact that we had opened above a trend line. So early in the day, I thought, aha, it's time to go. I didn't want to wait till here. I mean, there's potential we open above that, who knows, and then you're chasing the trade, you have bad trade location. So I thought today was the day, on Friday the 19th, as I'm speaking to you, to start to initiate gold long, and if the consolidation continues, it's just going to be my usual MO. I will be selling call verticals and selling put verticals against that call vertical that I paid $1.50 for. I purposely find an expiry that's at least a month out, so I have 4 to 5 expiries of weeklies to sell against it, and I'll just rinse, repeat, and take it as it comes. And that's all for this week. Thank you so much for spending just a little bit of your weekend with me. So just a quick recap. We know that Friday did shake things up a bit in the S&P. We'll see what Sunday night gives us. We may be facing a large gap down, maybe not. At the same time, NDX seems to be so much more intact, and those Fangman stocks I talked about don't seem like they want to give it up. So we'll see where we're at. If the market catches a bid, no problem. We know where that buy point's going to be. We're just connecting those tops, and we know where we're going to break that trend line eventually on to the upside. All right. As always, if you like this analysis and you like hearing from me on the weekends, remember you can hear from me every day live via text message, my weekly options advisory, and also the Peter's pre-market perspective, which I showed you in this video. That's got a 5-day free trial. You can sign up and check it out for a week. If you don't like it, no problem. If you do like it, it's only $20 a month, which is fantastic. If you sign up for the weekly options advisory, I include that for free. All right. Thank you very much, I want to say, to all the people last week who subscribe to the channel and hit the like button. That does help us out very much here at ShadowTrader. So again, smash that like button down below if you like this content. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.